Hi, Stephen with Clarity Wealth for today's Friday Fireside Chat. I want to talk to you today about a phenomenon called the widow's penalty. And what this refers to is, as a married couple, when one of the spouses pass away, there's a little bit of a tax penalty for the widow or the widower who survives. What happens in the year that our spouse passes, we can still file our tax return married filing jointly, which means we get more favorable tax rates. The next year, we then have to file as a single filer, and we don't get the more favorable tax rates, which can result in higher tax bills into the future. And so there's two primary planning components that we want to talk about, neutralizing that and try to get ahead of these before these things happen, to say, hey, does this fit into the plan somewhere? So maybe we have traditional IRA assets that we say, hey, we want to convert these into Roth dollars prior to going to the individual tax brackets. Yeah, we'll have to pay those taxes in the year that it happens, but we'll get the more favorable tax bracket. The other piece is, if you have your home and you plan on downsizing or relocating, and you've been in that home for a while, as a married couple, you get a $500,000 exemption on capital gains, but as a single individual, it's only $250,000. So you have a 2-year period after a spouse passes away to leverage that higher capital gains of $500,000. We want to put those out there. It's never a subject we take lightly when we talk about it, but we do think it's important to share these considerations so that you know from the tax side what that looks like. If you have any questions, we look forward to hearing from you. Have a good one.